$1 billion. Let that number sink in. That is not a corporate valuation. That is not a government budget. That is the amount of trader wealth that was incinerated in a matter of minutes yesterday. If you are watching this, there is a high probability you felt the shockwave. The crypto market didn't just stumble on December 3rd. It was subjected to a violent, coordinated, and ruthless execution. Welcome to the Market Flash Special Report. I am your host, and today we are stepping into the ashes of the December flush to analyze exactly how the whales just stole the lunch money of every over-leveraged retail trader in the market. The headline is simple: Bitcoin crashed, but the story is complex. We witnessed a massive God candle, a vertical red line on the charts that sliced through support levels like a razor blade. It wasn't driven by a hack. It wasn't driven by a tech failure. It was driven by the most dangerous force in financial markets: hubris. To understand why this happened, we have to look at the setup. For the past 2 weeks, the crypto market has been in a state of delirium. Bitcoin was grinding higher, fueled not by spot buying, but by derivatives. We look at the data, and the warning signs were flashing neon red. Open interest, the total value of outstanding betting contracts, had ballooned to historic highs. Everyone was long. Everyone was betting on number go up. And they weren't just betting with their own money. They were betting with the house's money. Leverage ratios were hitting 50x, even 100x on offshore exchanges. When the market is that heavy on one side, it is like a boat tipped dangerously to the right. All it takes is a single wave to capsize it. That wave arrived yesterday. Here is the mechanics of the crash. A large entity, a whale, or a consortium of market makers, executed a massive sell order into the bid. This pushed the price down just enough to hit the stop-loss orders of the most highly leveraged traders, the 100x gamblers. When a long position is liquidated, the exchange automatically sells the asset to cover the debt. So, a liquidation is a sell order. This creates a feedback loop. The whale sells, now the price drops, to retail gets liquidated, to forced selling, to price drops further, to more liquidations. It is a cascade. It is a domino effect. And in a vacuum of liquidity, prices don't slide. They teleport downwards. That is what wiped out $1 billion in open interest in the blink of an eye. You might feel angry. You might feel like the market is rigged. And to a certain extent, you are right. But this isn't manipulation in the illegal sense. It is liquidity engineering. Think like a whale. If you are an institutional player, a hedge fund, a family office, or a massive Bitcoin holder, and you want to buy $500 million worth of Bitcoin, you cannot just click buy. If you do, you will push the price up against yourself, getting a terrible entry. You need someone to sell to you. You need liquidity. Where is the liquidity? It is sitting in your stop losses. It is sitting in your liquidation prices. The crash on December 3rd was a liquidity hunt. The smart money saw the map. They saw billions of dollars of liquidity clustered below the current price. By triggering the crash, they forced you to sell. They forced you to panic. And who was on the other side of that trade, catching the falling knives with a bucket? The same whales that started the slide. They flushed the leverage out of the system so they could accumulate spot Bitcoin at a discount. They shook the tree, and the weak hands fell off. This is a transfer of wealth from the impatient, leveraged retail, to the patient, institutional spot. Now, let's layer in the fundamental trigger. Why December 3rd? Why now? We are standing on the precipice of a major announcement from the Securities and Exchange Commission, SEC. Rumors are swirling about a new, comprehensive regulatory framework for digital assets. Some leaks suggest strict capital controls for exchanges. Others suggest a classification of most altcoins as securities. Markets despise uncertainty. The whales know this. They use the fear of the SEC announcement as cover for their operation. This is classic sell the rumor, but in this case, it was dump the uncertainty. By crushing the price before the news comes out, the market price is in the worst-case scenario. If the SEC news turns out to be even mildly neutral, the market will rip higher because the bad news is already priced in. But if you were liquidated yesterday, it doesn't matter what the SEC says tomorrow. You are already out of the game. That is the cruelty of leverage. You can be right about the long-term direction, Bitcoin going up, but be wrong about the path. the volatility kills you first. What is the fallout from this bloodbath? First, the funding rates have reset. Before the crash, longs were paying shorts massive fees just to keep their positions open. That was unsustainable. Today, funding is neutral or even negative. This is healthy. It means the foam has been blown off the beer. The market is lighter, cleaner, and ready for organic price action. Second, psychological damage. The retail investor is now scared. The fear and greed index has likely snapped back from extreme greed to fear. This is bullish for contrarians. You want to buy when people are fearful. Third, the destruction of the altcoin rotation. Many traders were moving profits from Bitcoin into smaller, riskier coins. This crash crushed the altcoin market even harder than Bitcoin. Bitcoin dominance is likely to rise as investors flee back to the safety of the king. This is the most important part of this broadcast. Listen closely. We are currently in the kill zone. After a major leverage flush, the market does not immediately go back up. It enters a period of high volatility consolidation. We call this the chop. The market makers widen the spreads. The algorithms are programmed to hunt both sides. If you try to short the market here, thinking it will go to zero, you will get squeezed by a relief rally. If you try to long the market here with high leverage, thinking the bottom is in, you will get wicked out by a retest of the lows. The volatility range has expanded. A 5% move in an hour is now normal. If you are using 20x leverage, a 5% move wipes you out. The market is currently a meat grinder designed to chop up anyone trying to be a hero. So, what do? The strategy depends entirely on how you are positioned. Scenario A. You are a spot holder. If you bought Bitcoin with cash and you are holding it in a wallet or an exchange account without leverage, your move is nothing. Do not sell. Do not panic. Do not let the red candle scare you out of a multi-year asset. The fundamentals of the Bitcoin network, hash rate, active addresses, institutional adoption, are unchanged. BlackRock didn't sell yesterday. MicroStrategy didn't sell yesterday. Why should you? This volatility is the price of admission for the highest performing asset class of the decade. If you can't handle the 20% drops, you don't deserve the 200% gains. Close the charts, go for a walk, zoom out. Scenario B. You are a leverage trader. You are in danger. The casino is rigged against you right now. If you are still in a position, reduce your size, cut your leverage. You need to widen your stops to survive the volatility. If you were liquidated, take the loss as a tuition fee. Do not, I repeat, do not revenge trade. Revenge trading is when you rush back into the market to try and win back the money you lost immediately. This is how you go to zero. The market doesn't owe you your money back. Step away. The market will be there tomorrow. Your capital might not be if you force a trade today. We must not ignore the macro. The crypto market is not an island. It is correlated with global liquidity. Yesterday, we also saw jitters in the tech sector. We saw the US dollar index, DXY, show strength. When the dollar gets strong, risk assets get hit. Bitcoin is acting as a high beta liquidity sponge. It is the canary in the coal mine. This flush might be signaling a broader risk-off moment in global markets, or it might just be crypto doing crypto things. However, keep an eye on the bond yields. If yields continue to rise, the pressure on Bitcoin will remain. What happens next? History suggests we will see a dead cat bounce, a small recovery followed by a retest of the lows to confirm support. We need to see price stabilize. We need to see volume decrease. We need the market to get boring again. Boring is good. Boring is accumulation. The smart money is currently placing limit buy orders at levels you think are too low. They are patient. The $1 billion liquidation event of December 3rd was a wake-up call. It was a slap in the face to the up-only crowd. The market is reminding you that it is a brutal PvP, player versus player environment. The whales are sharks, and if you bleed leverage, they will eat you. This is the great filter. It filters out the gamblers so the investors can prosper. If you are holding spot, you are the survivor. If you are leveraging, you are the prey. Stay liquid, stay humble, and never forget, not your keys, not your coins, and definitely not your leverage. This is the market flash. Survive the chop.